Buying calls when a stock is below the 200-day moving average is the fastest way to lose premium. Here is the specific setup to align momentum with your contracts. First, you must establish the dominant trend using the trend filter. In options trading, fighting the trend accelerates theta decay, so we use the 50-day and 200-day averages to filter our bias. Once the trend is confirmed, the biggest mistake is chasing the breakout. Buying at the top spikes implied volatility, meaning you overpay for the contract right before a natural correction. Instead, wait for the mean reversion pullback to the 20-day moving average. This is your value zone, where premiums stabilize and the risk-to-reward ratio shifts in your favor. When the price touches the 20-day line, do not buy immediately. Wait for a confirmation candle, then select a strike price with a delta between 30 and 40 to capture the move without paying for deep IDM intrinsic value. Here is your execution checklist for the week. Follow this strictly to stop guessing tops and bottoms. Respect the trend, wait for the bounce. Happy trading!